Next, we're going to look at the discounted cash flow model in the TagniFi plugin. And so this is one of the models in the model library. It's great for valuing companies using the discounted cash flow method. And so you can run any public company through this model. It's under commercial and industrial. And so if we just search for DCF, it should pop up here. So yeah, just hit open model. It's going to open this model we're looking at right now. And really, it's just a matter of putting a ticker symbol in. So for example, if you want to put a ticker symbol in, it's going to go out and pull all of the data needed to automatically run a discounted cash flow analysis. What it's doing is pulling in 5 years of history. So it's pulling in all of the historical data for a company. And so you can see just like this, we have Home Depot loaded as the company. Has actually 5 years of historical data as well as the latest 12 months data. Everything to come down to free cash flow. So we have revenue, EBITDA, depreciation, taxable income, income taxes, and also working capital and capital expenditure. So all that's used to derive a free cash flow number. What it's then doing is using a projection based upon the historical data and trends, right? So it's taking the historical growth rate and saying, okay, in this case, Home Depot's grown at 5.6% over the last 5 years. If they keep growing at 5.6%, here's what it's going to be worth. Any of these assumptions, these key assumptions over in these blue override boxes can be changed. So for example, if you think, Home Depot is going to grow at 10%, we'll change that to 10%. You can see that now is flowing through the projection. So, but the base case is just using the historical growth rates, but you can change the margins. Maybe you think the EBITDA margin is going to be 15% instead of 16%. So you can change that. So any of these can be changed, and then it's just going to automatically create that projection for the next 5 years. And calculate free cash flow based upon those assumptions. Discount those cash flows back, including a terminal value, and so there's also a cost of capital. So those are the key inputs, and it's flowing through the balance sheet. Basically, adjusting for cash and debt to come up with the market value of common equity, adjusting for anything like preferred stock or non-controlling interest. And then it's arriving at a value of the common equity. So in this case, it's saying, based upon these projections in the model and these assumptions in the model, it's saying that Home Depot is worth about $132 per share as opposed to the $285 that it's currently trading at. So would appear to be overvalued, but it's really based upon your assumptions. So maybe you run some different assumptions, you can come up with different inputs. Also at the bottom, all of the key data points, right? Or you can audit them, see like how EBITDA is being calculated, how the tax rate's being calculated, purchases of property, plant, and equipment. So this is your capital expenditures as well as working capital assumptions here. Also, you can change some of the terminal value assumptions, right? So here you have a long-term growth rate after your forecast period, and as well as the cost of capital. So this is going to be a big driver of the valuation as far as what the weighted average cost of capital for Home Depot should be in this case. So everything there you can change, and it's going to automatically update and change and flow through this valuation to calculate a value per share for any of the companies in the TagniFi database. So that is the discounted cash flow analysis.